What's up, guys? So we're going to talk about bond yields. How exciting! I think it's important for us to understand what they are and why they're important. They're usually a telling sign, not always, but usually of a recession to come. So we have just like a regular chart right here, right? And we have 2 year, 5 year, 10 year bonds, and you have interest rates on the right. 1, 2, 3, 4%, whatever. In a healthy economy, the yield curve looks something like this, or actually like that. You, for holding a 10-year bond, you get paid more interest, and for holding a short-term bond, you usually get paid less interest. Kind of makes sense. If you're parking money, you should get paid more and rewarded more for holding parking your money for longer versus parking your money for shorter. And in times where the economy is good and great, not that many people want to hold long-term bonds. They're like, yeah, I could park $1,000 in a 10-year bond, but I'm only going to earn 4%. Interest rates are at like 3% right now. Let me sell this bond off and go into stocks, go into real estate, go into a business, go into whatever else it is. As people start selling those 10-year bonds to go ahead and go ahead and play, right, and make more investments that are more risky. Of course, stocks are always risky. Everything else is risky because bonds are 100% guaranteed. What happens is on the 10-year, that interest rate starts going higher because when you're selling off, the next person that's buying from you is buying that at a discount and they're going to get a higher yield, right? And then, everyone's partying and doing whatever and investing and having a grand old time. And remember, bonds, or at least government bonds, are the safest asset possible because it's backed by the government. You're going to get paid 100% of your money. It's not like buying a corporate bond. Even, there's a risk. It's not likely, but there's even a risk that if you bought Apple bonds, Apple could go bankrupt and then you're left holding a bag, right? So that's why historically, it's not even historically, it's just a fact. U.S. bonds are always the safest asset. So what's this yield curve inversion means? Well, on the left side, the short term, the 2 year, the Federal Reserve controls that interest rate. And on the long term, investors control it because they're the ones buying the 10-year and the 30-year or whatever. What happens is when you have the 2 year bond, when the Federal Reserve starts raising rates, that 2 year goes up, right? And then people start getting uncertain about the economy slowing. They don't know where to put their money. They're like, oh man, I'm not going to put it in stocks. They're bleeding. Real estate prices are still high. It doesn't make sense. Let me just put this money into the 10-year bond, right? And let me just park it there. I'll make somewhat of a return. I don't know what the next, 2, 3 years, 4 years are going to bring, but I know if I buy that 10-year today, I'm locking in, this rate. So what happens is all the smart money, all the institutions, insurance companies, pension funds, whatever, start buying that 10-year. When everyone starts buying that 10-year, right, the price of that interest rate starts coming down, right? When they're always inverse, right? The more you pay for a bond, the less interest you're going to get, right? So what happens is the 10-year ends up earning less interest, and then the 2 year is controlled by the friend ends up earning more, and that inversion is like a oh snap indicator for you as an investor, like hey, things are going to be uncertain. Then if things starts turning back around and then that 2 year the Federal Reserve starts cutting rates, it starts going lower, then people start selling the 10-year bond off and going into stocks, going into whatever, and that 10-year starts going back up, and then you have that nice curve again. So just to recap that, when things are great, the interest rates on the shorter term interest rates are lower, right? And people that have their money parked in 10-year bonds start selling those bonds off to invest in stocks, invest in business, invest in real estate. That 10-year starts climbing, right? So you have the curve that looks like this. When the early, 2 years starts going up, people here start getting scared. They got to park money somewhere. They start buying the 10-year like crazy. And that causes, when you buy a shit ton of those 10-year bonds, that interest rate starts coming down. So it ends up being inverted. It looks like this. It looks like I guess you could say an L, but it's not an L. It's like a curve down versus how it should be, which is a curve up, because you shouldn't want to hold 10-year bonds if you think that money is better put to work today into a business, into real estate, into whatever, right? So you as an investor, it's not always When that curve, inverts, that is saying 110% of recession, it's all loom and gloom, or loom and doom, or gloom, or whatever you want to call it, right? It's all bad. It's only the biggest indicator of that is if it stays inverted and for how long it stays inverted. It's been the telling sign since even the 70s that a recession is coming. So right now we're seeing that inversion happen where people are like, I got this cash, but I don't trust stocks. I don't trust real estate. I don't trust these things. Let me pile into the 10-year and park my money there for a while and see how this thing all shakes out. When you see that happening, that usually means overall the economy is going to slow, and it's a way for you to see the health of the economy. It doesn't mean it's going to stay like that, and if it does, that usually means a recession is coming, and that's not always the case. But it's another indicator, it's another tool for you as an investor to be aware of, and it's very easy to look it up. You can literally go on the Yahoo Finance app, go to the market section, scroll down, you'll see the bonds, you'll see the 2, the 5, and the 10. Well, if the 2-year is paying more than the 5 and the 10, that means a lot more people are piling into the 10, and the yields are inverted, and it's just a sign. It's something for you to be aware of. It's not the end all be all. There's a lot of factors that go into it. But the times that we're in right now, guys, are uncertain. We've had since 2008, 2010, we've had historically low interest rates. Everyone's been running on funny money, and now the money's not funny anymore. If you want to borrow, you're going to have to pay top dollar. So naturally, it's going to, I predict 100%. If we're not already in a recession, whatever a recession is defined now, which should be 2 quarters of slow economic growth, but yeah, I guess we're changing the definition on things. But it doesn't take a rocket scientist, guys, to know that troubling times are ahead, especially knowing that the Federal Reserve is not anytime soon, at least the rest of this year, going to cut rates. They actually came out and said they're going to raise rates. The debate is if they're going to raise it another 100 basis points, which is 1%, or maybe more. So as an investor, you kind of know now is not the time to be buying anything because we don't know how things are going to shake out. So now's the kind of time to either park your money in something that's really safe or just hold cash and just wait, be patient. Majority of the time, being an investor, there's not a gun to your head saying you have to put money to work right now. No, that's not how the game works. Every single day, the market is presenting opportunities for you. There's stocks out there, they're priced this day at this price, they're priced, whatever. You don't have to buy it. You could sit back and wait and say, I'll buy it when it hits X price. That's when I'm comfortable. I evaluate this. And same thing with real estate. Just because there's things going for 110, 125,000 a door right now, you're like, that doesn't make sense. Wait, just be patient. Time is on your side. No one's forcing you to buy anything, right? You only buy stuff when it makes sense. You should never be in a position where you're like, oh my God, I just have to buy. I have to, that's how you'll probably still be okay because as long as you're investing in something that's solid and earning you a return in the long run, you'll be okay. But why be okay when you can get a great deal, right? Those returns are exponential if you buy something at a fair price and you ride the wave up versus when you pay an extreme premium and then wait for the evaluation to catch that. Does that make sense? And of course, guys, there's way more tools. If you go on Investopedia, you can learn about the yield curve. You go on YouTube, there's a lot of great videos to learn about the inversing bond yield and even bonds in general. I'm just a guy with an Instagram account. I'm just giving you my 2 cents. And the most important thing you need to realize is paying attention to the 2-year and the 10-year. That's what all the smart money looks at. When the 2-year is paying more interest than the 10-year, that's not good. You should get paid more money for holding something for 10 years than you should be for holding something for 2 years. It's plain and simple. That just means there might be trouble ahead. Now, if this continues, right, and we continue to see the 2-year worth more than the 10-year, then that's when it's going to be a problem. And this is, like I said, another tool you could add to your investing belt and, pay attention to maybe once a week, pop it up and say, it's Friday. Let me just see what's the 10-year at, what's the 2-year at. Oh, look, we're still inverted. If that continues on for a whole quarter, that's probably telling you it's not a good time to invest right now. Anyways, I hope this video helped, guys. If you like this, please share it with a friend. Save it. I think saving it helps. I don't even know what the little sticker thing is on the side there. And, check out my website, guys. I have 2 free courses available, the options basic course and the real estate analysis course. They're absolutely free. I want you guys to learn. I want all of us to win and make money. It is possible, but you have to deploy a certain level of discipline. And of course, if you support my channel and you like the work I do, you like the stuff I post and the time I put in, join the Discord. It's $5 a month. You get access to everybody else in the community, talk to all my followers that also have joined, ask questions in there. It's a great place for us to learn and grow together. And you could probably put $5 in my pocket, and if you're top G, $10 in my pocket. Still cheaper than a cup of coffee, I believe, depending on what city you're in. Anyways, thanks guys. See you next time.